Good evening, everybody. Welcome to the first of hopefully many to come VMAP, Virtual Selfish Investing Managed Account Program quarterly webinars. And during this webinar, we want to go over some critical issues that the program is facing currently, and I think everybody knows what those are. But before we move on, I do want to remind everybody, besides thanking you for taking the time to attend this webinar, which will be recorded and available for 48 hours following this live broadcast. But do keep in mind that this is a private webinar. It is intended only for the investors in the VMAPs, and we do not want it being spread around or distributed around, and if we catch anybody doing that, we will sic our lawyers on you. So we like to keep things private. This is a small group of people, about 70 to 80 investors in the VMAPs, and we are a small group here, and we keep our affairs private as far as when we're talking about the market and what our approach is going to be going forward, particularly in strategies A and B. So I'm sure those of you who've been waiting in the waiting room and you're able to see the screen here, you've had plenty of time to read this, so I think you know the story there. Anyways, the main issue with the strategies A and B, which are the 1x and 2x leverage ETF programs, where we're half as much invested in A as in B, I believe that's how that works. Essentially, Dr. K, Chris Ketcher, is pulling the trigger on those. Chris is with us right now, or as I like to call him, Dr. K, live with us from London. Dr. K, you're there?
I am.
And we also have Ross Haber, our good friend who's a former portfolio manager at William O'Neill & Company, who is essentially overseeing the C program. And I function essentially as a consultant or idea man and feedback to both of them in terms of what we're trying to achieve in any particular market trend. Now, the big issue for program A and B, and a lot of people wonder, why are we down so much when the market has been up in 2012? And two things are working against us. Most importantly has been the fact that the market started, running up in January of 20, and we did not start the program until March, middle of March, and it actually turned out to be a reasonably difficult time to start the program given the number of signals. Now, Dr. K, I'm going to let you discuss what we've been seeing with the model, what's been occurring, and how you see things panning out, and what steps we might take going forward to improve the situation, or at least keep ourselves in a position where we can make progress without hopefully getting whipsawed out too much or too late.
Thanks, Gil. Yeah, as MDM issued a neutral signal on October 15th, the VMAP A and VMAP B have been in cash. Now the model has moved to a sell signal after today's close, and the TVIX UVXY model, which is discussed on selfishinvesting.com, and that runs inverse to the MDM, that went to a buy. So you will note that the MDM sell signals can be very short-lived, especially in this age of QE. So it's entirely possible that this sell signal on the MDM will switch as early as tomorrow, depending on market action. In other words, in this whipsaw environment that we're in, it's very important to favor cash positions. So the model takes that into account. And that said, 2012 has been a true aberration, much as the second and third quarter of 1999 were highly unusual periods. The model, incidentally, had its worst drawdown in 1999 of 15.7%, minus 15.7%, and that was up until this year, 2012, when its drawdown hit minus 18.1%. Now, as expected, this year has also proven to be one of the worst years for many of the what they call the trend-following wizards, and they collectively were down again in September of this year. Now, these wizards represent a group of fund managers who've been interviewed in books such as the Jack Schwager's Market Wizard series and Michael Covel's Trend Following, and these are guys who hold absolutely stellar 20-plus year track records in their hedge funds. So that they are collectively down this year, and not only that, they were collectively down at the end of March of this year, and that was after a fairly ferocious uptrend in the major indices. And that speaks to the nature of this market environment we're in, that we find ourselves in 2012. And Investors Business Daily actually wrote something in their big picture column, and I'll just give you a quick paraphrase here, that quick turnabouts in IBD's big picture had been the pattern since the indices marked intermediate lows in early June. In less than 2 months, IBD's big picture has switched 6 times. In other words, they admit to getting whipsawed as well. And they say, look at the NASDAQ's daily chart shows why. Action has been in an uptrend, but in a sloppy, choppy fashion, something investors saw in 2011. But predicting the market is not IBD's mission. The goal of market policy is to describe current conditions. Why is that so? Well, part of bad investing is guessing what will happen next. The disciplined investor rather simply tries to grasp conditions and plays that reality. Right now, indecision rules as the market struggles. End quote. So first, a bit of overview of the last 2 years. In 2011, despite its general trendlessness, we were up well into the double digits using the MDM after testing our positions in gold ETF GLD and the silver ETF SLV.
Dr. Kidd, can I interrupt you for 1 second? I should point out that that was using the model in a test fund back in 2009 to 2010, I believe, is when we actually were using the model in a test fund. And then after 2000, I think late 2010, we've been using it in another fund that is not related to the VMAPs, and that actually was up around 24% last year in 2011. So I just wanted to point that out, that it wasn't the VMAPs that had that performance. So, well, one thing I would like to just throw in real quickly, Dr. K, is in your discussion here, if you could address one question. It's just if the market's up for the year nicely, and why are the VMAPs A and B lagging? And if you could answer that question in your discussion, there are some questions regarding that coming from the listeners.
Sure, absolutely. I mean, part of my answer is that this is a very aberrant market, as illustrated by, that the trend-following wizards by the end of March were collectively down, and some of them were down double digits, even though all the major indices, if you look at the performance for that first quarter this year, they were all up fairly strongly. And that speaks to the highly aberrant nature of this market environment we're in 2012. But I'll also address other aspects of that question in a moment. Now, as I was saying, when in 2011 we were testing these positions in the precious metals ETFs and in stocks as well, and we were suffering a drawdown of something over 20%. And so this is to say that our initial positions in precious metals ETFs and various stocks were met with failure in 2011. But we eventually caught trends and pyramided them successfully, which made all the difference. Now this year, in 2012, in a similar vein, our recent positions in silver 3X ETFs, USLV, and TECL, which is a 3X ETF that's a technology-based ETF, they were recently met with failure despite quantitative easing coming from the U.S., the U.K., and Europe. And initial favorable price volume action in leading stocks and major indices that we observed as a result of this favorable QE announcement and environment. And these favorable announcements and proper price volume action was seen from late August to mid-September. Now, since then, the market's rolled back over. It's reversed its gains in recent weeks, and as its slop and chop rhythm continues, it makes for one very challenging environment. We will be testing a possible buy in a silver ETF as SLV pulls back to its 50-day moving average, which it is a breath away from doing. And right now is somewhat like July 2011. That month in 2011 marks the MDM after it had issued a series of false signals. I think something like 6 or 7 in a row. But then it more than made up for it with far larger gains on true signals that ensued, and that allowed the model to finish 2011 well ahead of the major averages as measured by any ETF or index such as the NASDAQ Composite or the TECL 3X ETF. Now, MDM is no stranger to challenging trendless periods, as it is countered in 1999, in 2007, and in 2011. But it has always managed to eventually well outperform, as the general markets have always returned back to a more normal form of trade. Now, that said, right now the markets are anything but normal, and adjustments have been made in the form of refined entry and exit points, as well as putting into effect a strategy that is based on MDM signal switches as applied to volatility ETNs, such as TVIX, UVXY, XIV, and VXX. Now, this is a volatile model. That applies to volatility ETNs, but it is a volatile in terms of its performance. It can be up strongly or down strongly, and so only small position sizes are taken. But real-time testing since June of this year has so far proven out the back tests, and we discuss this TVIX UVXY model on our website. So we will be deploying this strategy shortly, and these adjustments are, from the looks of things, they're going to be here to stay, since they seem to work in all types of market environments, and they can only, from what I'm seeing so far, they serve to enhance performance rather than detract from it. So while we're in this challenging environment, I think this type of strategy can help the performance, and it may even override the buying of normal ETFs or inverse ETFs, depending on the model signal.
So, Dr. K, are you saying then that you're using a short-term sort of derivative of the model to begin taking more of a short-term view and becoming more active? Is that what you're saying?
It's not going to be a. I would say that this TVIX UVXY is going to be it's going to issue. To be clear, buy signals very rarely, and buy signals mean sell signals on the NDM. It's going to more likely be in cash for the most part when the MDM is issuing a sell signal. Now, when the MDM is issuing a buy signal, the model is generally not a short-term model. The signals tend to, the buy signals on MDM, which somewhat correlate, not one-to-one, but somewhat correlate with the sell signals on the TVIX UVXY model, can be held for usually a number of days to weeks. So it is not a short-term type of signal. It can be short-term, but the idea is, for instance, in its most recent sell signal that was issued some weeks ago, we just closed it out at a profit of 48.8%. Now that is going short UVXY and covering it on the change in signal. So the idea here is, if you look at the TVIX and UVXY, you'll notice there is a definite downtrending bias in these instruments. So these volatility instruments give you quite a bit of an edge, I would say, in terms of going short. Now, going short these instruments correlates with the MDM going long, MDM issuing a buy signal. And as you can see, these downtrends persist often for a number of weeks. And that explains how the TVIX UVXY model was able to generate a 48.8% return in its most recent signal, which lasted a number of weeks. So yeah, that's all to say that buy signals on TVIX and UVXY will tend to be rare and short-lived. Sell signals will tend to be more frequent and longer-lived. So therefore, I think it works well with the VMAP A and B programs to use the model, the TVIX model, on the sell signal.
So then you plan to be using these ETFs going forward?
That's correct.
Okay. Now,
but as people will see, there's the returns are quite high, and there's a wide banding level of returns. So on the website, people can get a sense of the risk reward. They can, we have members on VOSI, for instance, that are trying their hand with this model, and we advise them to keep your position sizes small. If you're using something like an XIV, which is an inverse, it's a 1x inverse, that's obviously going to have half the volatility of UVXY. So you can go in with twice the size of our recommended positions.
You would use the XIV in lieu of going short, say, the TVIX or the UVXY.
Yeah, and simply because, well, the TVIX and UVXY, first of all, most brokerages will give you a borrow, but often they come with a fee. Right. Usually a percentage fee that's annualized, so it's not a huge fee, but I like often just being able to buy outright, XIV, and again in real-time testing, I've noticed that if you buy XIV or you short VXX, your performance is comparable. So you're not really getting an edge by shorting UVXY compared to buying twice as much XIV. And you don't have to pay the annual service charge, the annualized APR on shorting, getting the borrow on UVXY or TVIX.
One question that's asked frequently, Dr. K, is why is it the managed accounts are so underperforming the markets, the major market indices so far in 2012? What has been the root cause of all the whipsaw signals in the market direction model?
Right. As we talked about on VOSI in at least a couple of reports, the market in basically beginning in May. Well, first of all, we haven't had any really clear or clean trends. The model did hit a correct sell signal in April, which on our website it was nicely profitable. But since May, it's been very choppy, and choppy just enough so that the model will switch signals to a sell right on the day that the market decides to reverse and go back up. And you can see that if you look at the history of the NASDAQ going back to 1971, this kind of pattern doesn't exist. This is the first time we've seen this kind of banding. If you go back to, for instance, August and September of 2011, you'll see a much wider banding. In other words, the model was hitting the buy and sell signals just right. It had five very profitable signals in a row starting in late July, or I should say, yeah, that's right, late July, when the markets just started to fall apart, and then it had 5 more good signals. Now that kind of banding, the model finds is predictable despite the erratic look of the market back in July, August, September of 2011. Now contrast that with what the market's done since May of this year. The banding is just perfectly wide. Well, it's not wide enough for the model to make profit, and it's not shallow enough for the model to not issue a switch in signal. And as I was reading in IBD some time ago, and as I was talking today, they were talking about how their big picture column got switched, made six switches since well, basically in less than 2 months. So that speaks to the nature of the tricky nature of these kinds of oscillations that we're seeing this year in the general market averages. And so we're getting basically a sloppy, uptrending market, but it's very choppy, and it's just enough to cause MDM as well as apparently big picture. There's just enough to cause them to switch signals just at the wrong time. And
so I think to put it all in layman's terms,
the model's taking that into account, and it's realizing we're still in this choppy, trendless phase. So the model went to a cash signal. Right now, it decided to go to a sell simply because we're seeing continued deterioration and selling pressure in leading stocks and in the major indices, and therefore, the sell signal is on. But as I said, it could be very short-lived. If the market falls, for another day or two and then stabilizes, the model could very well go back to cash, and it then needs to see a follow-through day. Well, once the NASDAQ falls at least 6%, then it needs to see a classic follow-through day accompanied by confirming action in leading stocks. When I say classic follow-through day, I mean it needs to see, usually on day 4 or above, that the follow-through day would be counted as an acceptable follow-through day. In the meantime, a follow-through day can come at any time because the NASDAQ has not fallen at least 6%.
So, Dr. K, to sum up, what's been going on with the model this year and the reason we've been losing money, and that really is a critical issue for the VMAP A and B programs, or strategies rather, I should say, is that last year when we saw this sort of volatility, the band, as you can see on the chart, was wide enough to trigger buy signals at the bottom and sell signals at the top. And this time around, in this summer actually, we're seeing in 2012 that the signal, the band is less wide, and for that reason it's triggering signals at the opposite inflection points, and that's basically what's been going on. And so the market can continue to go higher and chop its way higher and whipsaw its way higher, but if you're getting a buy signal at the top and a sell signal at the bottom on every zig and zag, you're going to end up losing money, you know, by a death by 1,000 cuts essentially, and that's really what's been going on with the VMAP A and B. Now the question becomes, and this is something that people bring up all the time, Dr. K, is that does this mean that the model isn't going to work anymore because it hasn't worked for this period, you know, in here that I'm trying to circle here, but right in here, it hasn't worked for that period, and so it's never going to work again. What would your answer be to a question like that?
Right. Well, if you look at the model's returns, which we post on our website, selfisheinvesting.com, and we have all the returns, the long-term returns on the NASDAQ, using the NASDAQ composite as a benchmark, and you'll get a sense of the rhythm.
Yeah, right? Yeah. One time.
You'll get a sense of the rhythm of the model. And you can go back into 2007, you'll see that the model had strings of false signals. I mean, 2007 was its, in terms of overall returns on a year-by-year basis, 2007 was its worst year, simply because the price-volume action of the major indices was very, there were lots of distribution days in 2007 that pushed the model into sell signals, and then the market would get back up and go. And that kept happening over and over in 2007, leading to a lot of false signals. Now, my initial reaction was, gee, should I change the model, or should I change or make allowances for this? And I realized that 2007 is an aberration, just like second and third quarter of 1999 was an aberration. These are short-lived aberrations in market patterns. And so, as I said earlier, the MDM is no stranger to drawdowns. It's had these difficult periods, but the key is to not change the inherent logic in the model. You can make small, minor adjustments, but if any adjustment you make, you have to realize that, first, it might only be a very temporary adjustment because market conditions generally go back to normal, or let's just say the period, the aberrant period, always comes to an end. It's never persisted. And this is based on studying over 100 years of market history. You do get choppy, challenging periods. You can go back to the late 30s, even the 40s. You can see aberrant periods, but they're short-lived. And if you were trading then, it would have been a very challenging environment. But the key was not to throw away your strategy or to modify it in such a manner that once conditions returned to normal, you were then left out in the cold because now your strategy has changed because it's thinking the market's going to stay aberrant, but it actually normalizes. And then you miss out on potential profit opportunities, and that can compound the psychological difficulty that investors have in dealing with markets. I mean, keeping it very clean and keeping to your strategy that you know has worked for a very long time, and knowing that the markets knowing that these aberrant periods end, I think is a very big, very important piece in strategizing and keeping to your strategy, keeping faithful to the essence of your strategy. Now, of course, if the market goes into a complete tailspin and becomes completely unpredictable, well, then I think that's never happened, and that would be a first time, and I think that would just throw everything out of whack completely, but there's no evidence that that's going to happen.
Right, and some people will say, that we're in a QE, quantitative easing, otherwise known as Fed money printing, has permanently altered the environment for the market direction model, and I would argue that really what you're looking at right now is an aberration that seems to be timing itself just perfectly with us beginning the VMAP program, with the VMAP A and B strategies, just to kind of to provide us with some initial headwinds for the program. But we know that the model has worked well because we've used it ourselves in 2010 and 2011 to make money in a period where you've had a lot of QE. We may be getting into a period in 2012 where the effective QE is becoming diminished, And we might note that after the Fed announced this QE3, or what I like to call QE-ternity, which is QE for as long as it takes, the market really just had, as we look at the daily chart of the NASDAQ here, let me blow this up a little. The market, this was the day right here that the Fed announced QE-ternity. You had one more up day and then another test of that high right there, and then boom, we've come down ever since. And it seems odd to me that with QE-ternity being announced by the Fed, why isn't the market just rocketing? And at the same time, you see the silver and the gold both trying to break out, and they also fail. And it's kind of interesting because it could be telling us that maybe the era of QE in the next few months is going to come to an end. A Romney victory in November, he has stated that he will get rid of or fire Fed Chief Ben Bernanke when his term is up, and that he opposes quantitative easing, which, you know, anybody who is a dollar holder or a holder of any dollar-denominated assets doesn't really want to see the dollar devalued any further, so everybody has a stake in that. And if Romney does do that, then that could be considered negative for QE, and we may return to more so-called normalized trends sooner than we think. So I think that to prejudge the model and even ask us whether, you know, after 4 or 5 months of this aberrant sort of action and all these misdirection signals that we've been getting, that all of a sudden we have to abandon the model. Remember, Dr. K, what's the largest drawdown the model has experienced using a 1x ETF?
Well, the largest up until this year was 15.7%, and that was in the second and third quarter of 1999. And if people look at the NASDAQ, they'll see that that kind of pattern, it's a very choppy, volatile, uptrending pattern. That has never occurred in the NASDAQ, ever.
Okay. Now, how about in 2012? What is the drawdown?
And well, no, that 15.7% in 1999 and 18.1% in 2012.
Okay, so that's using 1 time. So if you're using 2 times ETFs, then you could be down 36% if you're going full boat. So my argument here to our VMAP investors would be that what we're actually doing is mitigating what could be even worse performance, especially if you're in program B, which could be down 36% if we just went full boat every time we had a signal using 2 times ETFs, which is roughly how the program is intended to work, but we have been taking some steps to mitigate that. And I should also remind you all that we don't consider drawdowns of 15, 20, 25% as that big of a deal to us. In our careers, those have been easily surmounted deficits. And I think what becomes very important for us when we do have this sort of period, and just remember, because we worked for Bill O'Neill doesn't mean that we have magic powers and every time we touch a stock it goes up, or an ETF it goes up or moves in the direction we want it to. We do have periods where we lose money. That happens. And you can go onto the website and look at our audited track records that we provide, even during the period of 1997 to 2005, where I made almost 11,000%. I had some serious drawdowns during that period, but that was just how, that was just a function of the methodology. Now I'm using a much more aggressive style, and this is a little bit more muted, so we would not expect to see much more drawdown, and I think if we did, then that would mean that we're really in a very aberrant period. And I think that's really the solution going forward, and we've been implementing that. So there has to be some confidence in our ability to come back from a 20% deficit in Program B, which is a 2 times ETF program, and I'm not sure where Program A is. But we will have by year end official numbers for the program, and of course those will be public. So you know, it's nothing that we're disturbed by per se. It does show us that there are some difficulties using the model right now, and so we act correspondingly by not becoming so concentrated. And in fact, the downside performance in the model in 2012, we've actually muted in the VMAPs, even though it may not feel or look that way. So that's really how we're going to proceed going forward with A and B. Now, I want to get to Program C. Dr. K, if you have anything to add on A and B, I think you can do so now. Otherwise, I'm going to move on.
I think we've covered A and B very well. I mean, if anyone has any further questions, they're more than welcome to ask. But I think I've said everything I need to clarify where we're at in those programs.
Right. Now, I want to remind people who are aware of all 3 programs that A and B use the market direction model signals to implement ETF positions. Okay. Whereas Program C isn't doing nothing more than building a stock portfolio during a trending market, a bull market, using only stocks and no ETFs. And we do it independently of the market direction model. So it may be that even though the market direction model isn't on a buy, Program C may be buying stocks. Now, Ross Haber is with us from Dallas, Texas. Dallas. Ross, are you there?
I'm here.
Now, Ross is basically the man pulling the trigger in Program C. And if you'll notice, one thing that is the hallmark of our trading as O'Neill managers or former O'Neill managers, we're very active. Even Bill O'Neill himself. Getting started, we think the market's starting to trend, and we'll get into positions, and then we don't like what we're seeing, we'll back away, and we'll come back in. We may do this 2 or 3 times before we decide that, A, the market sucks and we don't want to deal with it anymore, or B, we've got a nice trend here that we can build with. And Ross has experience running large portfolios. He was a co-manager or assistant portfolio manager, rather, of the Affinity Fund, and that was about a $750 million fund at its peak. And over the time period of that fund, I believe it roughly doubled the money of the investors who started out in the fund. Is that correct, Ross?
Yes.
So, he knows what he's doing. And in this environment, Ross is very risk averse. He doesn't want to lose money. And so we talk pretty much every day. We consult over the stocks that we're looking at. Dr. K has his input there, so we're all pretty much on the same page in terms of the stocks that constitute our universe of Bible stocks or investment ideas that we're currently interested in. And so, we discuss these and our strategies and approaches to taking positions in them. If we don't like what we see, we can come in, take 4 or 5 positions, usually 5 to 10% positions, not very heavy from our perspective. And if it doesn't work, we back away very quickly. And Program C has remained relatively flat. And it really just got started in July. And you can see in a number of the stocks where we've been trafficking, you've had some nice moves, like LinkedIn had a nice move up off the 50-day where we started buying and ran up into the 120s, but now you see it breaking down. There's been a couple other stocks that were even worse. I know at one time we were trying to buy a little bit of Mellanox along the 10-day moving average on these pocket pivots in here, and now this thing is blown apart. And so you have had an environment where if we did not remain risk averse, and we took even small positions, 5 to 10% positions, and held on to them as if somehow we're long-term investors, which we're not, we could be underwater pretty seriously there. But you can see Strategy C is designed to minimize risk, and Ross will implement the risk management techniques, the position building techniques that he learned to use very well while running a very large hundreds of $million-dollar fund. So we're trying to bring that to Program C. So it may not go that fast. Don't expect that you're going to make 1,000% in a year in Program C, but we do think we can outperform the market over the long term while minimizing risk in difficult environments such as we're in now. But eventually we do think you'll catch a trend in stocks on the long side where you'll be able to make a lot of money. It doesn't appear that that is the case right now. So, Ross, do you have anything to add in terms of your general style? I know that you tend to like to buy more on weakness. You may notice that some of the positions we take are taken on pullbacks. Is that generally how you like to buy?
It is. I'm watching the same sort of O'Neill stocks. I'd say that you, myself, Chris, all of the guys we know that still work at O'Neill, and all the guys that follow our style, if we were to match our buy lists, so to speak, that
Probably the same, yeah.
80 to 90% of our names are going to be the same. I think anyone who's been doing it for a while understands what the leading stocks look like. Now, when you say weakness, I'm looking at these leading stocks that are displaying overall strength and trying to buy them on weakness, meaning low risk but high probability buy points where I can enter a stock that's liquid for the most part, and if it, depending on the liquidity, I adjust my position size so that I can set a logical and reasonable stop. That way it gives me a chance to, let's say, enter a stock early if it's not quote-unquote necessarily what Bill O'Neill would consider a secondary buy point and such. So there's a few things that I would say. I realize that a lot of our clients that are in C came from A and B, and my number one rule is don't lose money. And that's my rule number 2 and my rule number 3. So every time I enter a trade here, that's my number 1 thing. I realize that I'm not running my own money and I'm not running Bill's money. And Bill O'Neill is not, you can't really base your experience off managing money for Bill and then expect the same thing from the public. So I learned a lot managing money with David over at Affinity, and I understand that you need to build a cushion and move forward, and you can become more aggressive after that. Now, you know, people will ask, well, what about the, let's say you build a cushion and people coming into the fund or the managed account program thereafter, what about them? Well, fortunately now we're not tied into one quote-unquote fund structure, and we're very, we can swing with the trend, we can move with the wind. So if it gets to the point where we do finally get into a trending market and A and B start working and I can become more aggressive with the C program, we can always divide that up, let's say, into, you know, C and D, so that if all of a sudden we had some people coming in and C was getting a little bit too aggressive for quote-unquote newcomers, we can make adjustments for that. That's all I would say. But every trade I'm putting on here, I realize who our clients are, where we're coming from, and my number one concern is, am I entering at the most optimal point with the least risk, the highest probabilities, where we can work our way in and out of these positions and not get hurt until the trend gets back underneath us. So that's what goes through my mind daily.
Thanks for that, Ross. That's a good insight into your head, I suppose. And having worked with you for as long as I have, or when we were back at O'Neill, I know how that head of yours works. But I think that what you're saying essentially is that you don't like to lose money. I love one of your favorite sayings is, there are times when I'd rather be out wishing I was in rather than in wishing I was out. And I think you use that to describe this environment more so than any other. And I think that's really true. And so I think your approach for investors who are risk averse, and what we find is, well, people will look at our track records and think, oh, 18,000%, 11,000%, you know, I want that. But you don't really understand the amount of volatility and drawdowns we have to withstand to do that. And I can tell you from my personal experience running a fund that people thought, oh, great, 11,000%, I'm going to get that. But they never really considered the fact that that was achieved with a lot of drawdowns. And the first time you have a drawdown, everybody freaks out. And I think if you can handle a drawdown that within the parameters of the model is relatively normal, and if we stop and think about, say, A and B, as I was pointing out, the model down 18% in 2012 with a 1 times ETF, if you're in program B using 2 times and you're only down 20 or 22%, you're actually doing a lot better than had we gone full boat. So you can see that there is some risk management or risk aversion in A and B, but it's really relative, and so that's a little bit wilder of a ride, but you should know that from having studied, hopefully, the performance of the model over the long term. Now with C, you've heard it from the horse's mouth from Ross himself, his approach, and as he said, he doesn't like to lose money, but I think that when we do get a good uptrend in stocks, there will be some leaders that he will latch onto, and we'll get a pretty nice ride out of them. So, you know, we have to be optimistic. As always, there are no guarantees, but we've always been optimistic throughout our careers, and whenever we've run into trouble, this is what has always brought us out. And we certainly don't need people beating on us over the performance of the market direction model. We've only had a couple of people get hostile, which I think is very bizarre, because we don't determine what the signals are. We try to do our best to mute what could be a much worse situation in our view, but it's not something personal, and so whatever you do, please don't try to interfere with our psychology by beating on us. If you don't like what's going on in the program in A and B, you can always move to C, or you can exit the program if you don't feel it's right for you. And we would prefer that people do that rather than feel like they need to hold a grudge against us or disturb us frequently, because that will just get in the way of our trading. And so that's one thing we would ask people to do. And I would also thank you all for the most part. You know, with about 80 investors in the VMAPs, we've only had 2 or 3 really over the last few months who have dropped out and been somewhat, I don't know, insulting and hostile about the whole thing, which I think is kind of bizarre. If it doesn't work, it doesn't work. There's nothing, nobody is doing anything to anybody intentionally with the idea of causing harm. So just remember that, and we're doing our best to get things on track. And as long as we have your confidence in that regard, then I think we can continue. But you do have to make the decision as to whether the program is right for you if you're in A or B and you're not happy with the results so far. I cannot tell you that I'm happy with the results of the market direction model so far, and we do use the MDM in a fund that Dr. K and I run for high net worth individuals. Dr. K and I both have our retirement money in that fund, and we're down somewhere in the neighborhood around mid-20s as well. So obviously we don't like it, but it's something we've dealt with many times in our career, and we'll continue to deal with it as we have in the past, and that's basically what we're going to do. So someone asks, would this be a good time to subscribe to A or B? If I had a crystal ball, I could tell you, and I don't really know for certain. I don't think Dr. K can tell you either, right, Dr. K?
Yeah, my crystal ball's in the shop.
Yeah, and yeah, those of you who are in the LA area, I should point out next weekend I will be at the High Growth Stock Investor Conference in person, talking about pocket pivots in the market environment. And I noticed somebody saying see you there next week. So if you're in the LA area, you should check it out. highgrowthstockinvestor.com, I think it is, or highgrowthstock.com. For that conference. But anyways, getting back to the topic at hand, which is where we're going with these, as I said, we're still confident that we can do what we normally do in a good market. We're just waiting for that perfect environment. So we're waiting for things to line up and all the ducks to get in the row, and they really haven't been. So I think it's
I wanted to say that in second and third quarter of '99, the model had its worst drawdown up to that point, and in my own personal account, I had that represents the worst drawdown I've ever had in 20 years of trading. Now, did I lose any sleep over that? No, actually I didn't. Now the reason is because I knew why it was losing money. I knew why the model was underperforming. Because again, I mean, having studied decades and decades of markets, it was psychologically comforting to know that this is a one-off, a once in a million type of situation. It's going to come to an end, just like all the other few aberrations that had occurred, since at that point I'd studied markets back to about the 1900s. So I was fairly confident that this period is going to come to an end. I didn't lose any sleep, and sure enough, by having that attitude, when the markets were off to the races starting in October of '99, I got back into full margin, I think within just three or 4 days off the market direction model's buy signal. So I was, ready to go, and I was able to capitalize on the last quarter of 1999. And I think that's a big key to successful investing, is to really stay focused and not lose your head and not lose confidence in your style of investing, whatever that style that is.
Yeah, I do think investors, though, need to consider from their own personal standpoint what kind of risks they really can tolerate on the downside, what kind of drawdowns. Because it's one thing to study the market direction model and see that, okay, it's had a drawdown this year of 18%. Before that, it was just under 16%. And you think intellectually you can handle that, but when it actually happens to you with real money, it can be a completely different story. And if you are reacting that way, then you should think about that in terms of either moving to C as an alternative to A and B, or simply sticking with A and B, understanding what the drawdowns can be. And as Chris has pointed out, a lot of trend followers, such as Bill Dunn, for example, have drawn down pretty decently this year because of the nature of the market's movement. And it's just been one of those bizarre years. So as far as VMAP program C goes, or strategy C goes, we're not going to be doing any short selling right now, mainly because we have a lot of retirement accounts in the program, and you cannot short sell in retirement accounts, so we really don't want to do that. One thing we might consider, if there is enough interest, is implementing short or inverse ETFs if we believe we are in a good bear market trend. So in other words, they would sort of revert to a A or B strategy depending on what Ross wants to do, and I'm going to leave that up to Ross to decide. We may end up doing something like that because we can buy any kind of ETF in a retirement program. Short selling requires a margin account, so that's one reason we won't do. And I don't think we'll go into margin accounts either, but we may also, as Ross was saying, you could have a C and a D program over time where we maybe make C a little more concentrated, or using more margin, or using margin really at all, and those would have to be only non-retirement accounts. So we know those are possibilities as we move forward, but really what we need to do is get the program on track, and then get some good results in and get this thing rolling, and then we can start thinking about moving off in variations of strategies and complicating it more, because right now we'd like to keep it as it is for simplicity's sake. Anyways, that's pretty much all we have for now. If you have any further questions, do email us at vmap@mochainvestors.com, and we'll be happy to answer. You can also just email us at any of the other Virtuous Selfish Investing emails that you might be familiar with, and it'll get to the right person one way or another. So I hope it's been helpful in helping you guys understand the program, where we're at, and just getting a feel for how we think about it. And you may notice from our tone of voice we're not all panicked. So, you know, my view is if you're panicking about your money in the market, you probably have allocated too much money to the market, and you should rethink your overall asset allocation. Anyways, that's all I have. You guys, Ross and Dr. K, if you have any final words to say, do it now. Otherwise, the bar is closed.
I think we're good. Well, I'm good.
All right, very good.
You the same. Everyone have a good night.
All right, take care, everyone. We'll catch you next time
so
we
long,
do
everyone.
one. Bye-bye.